Today I'm going to show you 7 Singapore stocks trading near 52 weeks low and see if they are worth buying. Watch until the end because I will be also talking about their recent news, valuations and analyst target prices. Throughout this video, I'm going to use Simplywall.st because they are absolutely awesome. They can provide information on global stocks and the user interface is just so slick. So if you are interested to try out the 14-day free trial, click on my link in the description down below to get started. And now back to the 7 stocks. The first stock on our list is Wilmar. Wilmar is Asia's leading agribusiness group and the business activities include things like oil palm cultivation, edible oils refining, flour and rice milling, sugar milling, manufacturing of consumer products and many more. So one of the reasons why the share price has declined is because of a bribery case in China involving Wilmar's subsidiary. The sentiment is pretty negative that may have resulted in Wilmar's low P ratio at 8.7 times now. In fact, it is trading relatively cheaper than Olam Group and Kerry Group. Analysts are also waiting for more clarity, but at the point in time, there are 14 analysts covering the stock with an average 1-year target price of 20.2%. The second stock on our list is Bukit Sembawang, a property developer of fine quality homes. It is not a well-known stock among investors because there are not many analysts or bloggers covering this particular company. The share price is down due to the recent drop in sales and profits. Talking about valuations, although it is trading at a low 0.6 times price to book, many of the local peers like Wing Tai, Google Land, and even City Developments trade at 0.6 times or lower, so there isn't much to shout about Bukit Sembawang here. Before we move on to the next stock, I would appreciate it if you can help me to smash the like button and subscribe to my YouTube channel so that you can tell the algorithm to push my video to more people. And in return, here's a financial meme for you. The next stock is Credit Bureau Asia, a leading credit and risk information solutions provider of over 330 million credit files in Southeast Asia itself. A strong foothold in Singapore, it is rapidly expanding to other countries, especially Cambodia and Myanmar too. So there are not many competitors with the scale and the offerings of Credit Bureau Asia. So I decided to take a look at the PE trend. So from this PE chart, I can see that the share price has come down not because there's many negative news or events, but rather the PE ratio was too high in the first place at around 45 times upon IPO. Given the double-digit revenue and profit growth, plus a stunning 30% ROE, this is a stable growth stock that you may want to take a look at and may suit dividend investors well. The fourth stock, yeah, luxury watch retailer Hourglass. Okay, so as per the recent results, the net profits are down year on year, and the management sounds cautious on the outlook attributable to the poor economic environment, which may in turn impact consumer sentiment, especially in this luxury watch sector. That being said, the Hourglass is trading at around 6 times price to earnings ratio, pretty close to the 5 times PE in year 2020 when investors were all terrified during the COVID period that nobody will buy luxury watches without going down to the store to have the touch and feel, right? So I'm pretty surprised that no analysts are covering this stock at the moment. But then again, I do take comfort that the company is aggressively buying back shares in the past year. On top of that, investors are also looking at a dividend yield of more than 5%. So the question is, why not this stock? Fifth stock, Nanofilm. As the name suggests, Nanofilm is a one-stop nano and micro fabrication partner from design to process engineering to manufacturing. It's easy to see why the share price has fallen so much from $6 in 2021 to only 72 cents in January this year. Nanofilm has been gravely impacted by the semiconductors seasonality and the soft 3C market. 3C stands for computer, communications, and consumer electronics. That said, it seems from the business outlook that things are starting to turn around as the customers' inventory rebalancing is improving and they expect higher sales in second half 2023 than the previous first half 2023. Analysts seem to agree here, but they also have been slashing their forecasted price targets. So remember to do your homework here. Last second stock, CapitaLand Investment. Okay, it is a real estate investment manager which houses the stakes in multiple REITs, funds, as well as the lodging business. There are private funds amounting to a staggering 22.5 billion equity value. But as retail investors, we will be more familiar with the various REITs and trusts under the CapitaLand branding or the umbrella, like such as CICT, Asandas REIT, CapitaLand China Trust, and more. Given the high interest rate environment and micro challenges, property firms will generally have a hard time since they are cyclical in nature. To make matters worse, CapitaLand Invest issued a profit warning that it is expecting a significant drop in profits due to the fair value losses. On a bright note, the company has been on a shares buyback spree following this announcement. It's as though they are hinting that the worst may be over, but for me personally, I will still wait for the results to come out before making any substantial move. Seatrium. I actually kept the most traded counter in SJX for the last. As you can see from the chart here, there aren't many notable events that would explain the drop in share price. I know a bit of technical analysis, so if you want me to chip in here, I would say that the decline is probably due to the profit taking, a lot of rebound and profit taking, and it is trading close to the support zone right now. This is at least an improvement from the 7.5 cents to the 10 cents region in 2021. Valuations wise, I do think that Seatrium has fallen off to a relatively cheaper 0.9 times price to book versus either Yangzijiang or Hyundai Heavy Industries. It is even cheaper than China shipbuilding when China stocks are all battered during this time. Analysts are also giving a price target of 17 cents too, implying a potential upside of an incredible 63%. So what do you think of Citrum? Let me know in the comments down below. And to wrap up, these stocks near 52-week lows are just ideas for you, so please always do your own due diligence. And also don't forget to help me smash the like button and subscribe to my YouTube channel if you found this video helpful for you. Help me smash. Next up, don't forget to check out this webinar replay here on my market outlook for 2024 and the stocks on my watch list. So I will see you next time. Thanks for watching and ciao.